Will this train ever stop? That's the question. When will we pull back as we climb a wall of worry? Or is it just full steam ahead with the destination far off in sight? I'm going to break all that down in tonight's video and what's driving the price action today. And then we're going to look in a beaten up sector for a trade idea on a stock within a beaten up sector that's closing at new all-time highs, new 52-week highs today. So let's go ahead and get started. Today is Wednesday, August the 29th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you who are watching us for the very first time. Glad you found us. Keep coming back for more. We get more and more of you every day. We appreciate you. And welcome to our Market Scholars community. Subscribe to our YouTube channel. Mouse over the logo right there in the bottom right corner of your video. And then click the red subscribe button that pops out. Also, click the thumbs up icon that's down below the video. That lets me know two things. You like the video tonight and you want us to do it again tomorrow. Comment on anything that stands out to you from tonight's video. Scroll down to the bottom further to be able to do that. Join our daily Market Outlook email list. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Follow me on Twitter for more content like this throughout the day. And then join our Market Outlook community on Facebook. All right, well, let's take a look at the S&P 500 first then with the market forecast indicator. And you'll see that we have strong bullish posture like we have had for a while now. It's dark green shading on the chart. I mentioned today in my class, in my options inventory class, if you look at the chart here, and granted, it's been a bullish year, and it's been a bullish 52 weeks. From when we came out of this bearish intermediate posture back in August, and then we rallied. I mean, year to date, past year we're up 19%. So it's a pretty good one-year return, with most of it being in 2018. Most of the year being in 2018. You can see the kind of rally we had heading into the end of the year. So, if you notice, most of that chart is green. There's a little bit of pink, but it's mostly green. And if you go back more time and go back, say, 5 years, and we'll do a daily chart on the 5 years, you'll see again most of the chart is green. There's some pink sprinkled in, a little bit more than in some areas than others, but for the most part it's darkly shaded green, which means for the most part the intermediate line stays up above 50. So if you and again, that's a pretty good return from the weakness we came out of in 2013 in August. Right, we had all that weakness there, a little bit of weakness at least. Since then, we've gone from 1628 up to 2916. So it's a pretty good 5-year return. Okay, let's go back to the regular chart. So the posture is bullish, and that's not a surprise. And it's not a surprise to us because that's what we've been bullish for a while. We've had a few brief near-term declines, but nothing to change the trend. And you notice that we continue higher. With the near-term line still up above 80. It's now been above 50 for 4 days. This is the first day, and then now these next 3. So 4-day winning streak, 4 days with the near-term line up above 50. 7 to 12 is a typical time frame, so that's what we're looking for. We also wanted to get above 80, so we can check that off in terms of looking for things to maintain the trend, right? When you're bullish like this, what you're looking for is you're looking for two things. One, to continue to match your expectations and continue the trend, or to not match your expectations, which would be a big red flag that the trend is changing. And so we haven't had that yet. We've got this bullish near-term high. We've come off of it to a new higher near-term high, and we're rallying. Now, and the market sentiment line is close to crossing above 80 again too. And again, 6 to 9 months is a typical time frame. Beginning of June, we are now almost 3 months into that. And we're in the second intermediate run of what we expect to be 3 to 4, if not more, if they're smaller intermediate rallies. And again, 1 to 3 months each. We're 2 months into this current intermediate rally coming off of that low point. So we continue higher, and we are heading into a holiday weekend, and at the end of, when this next week starts, we'll hit the 2-month mark of this intermediate rally. So that's when you can start to say, okay, at some point in time we will get an intermediate term pullback. which is going to be fine. The world's not going to end. The market's not going to go into recession. The market's not going to turn into a bear market mode. It could, right? You never know, but we wouldn't expect it to. We would expect it to just simply be an intermediate term pullback. Now, you know, the world's going to think it's ending. The world's going to think it's ending, but it's not. As of right now, that old near-term high point, or the old intermediate high point, which is going to be right about in this area, is sitting right in between the 50 and 60% Fibonacci retracements. So we can actually continue a little bit higher and bring up those old highs to the bottom end of this Fibonacci retracement zone, which means we can pull back into the retracement zone and stay above the previous intermediate high. So, which would be really nice. I mean, this one got down to like, this one actually went just a little bit below it. There's the old intermediate high. We went down a little bit below it during that pullback. But still, I think we were like at the 50% Fibonacci retracement. So the Fibonacci retracement zone is right around that old high point. And here it's about to be completely above it. So when you do get the pullback, and we will get shaded pink areas again on the chart at some point, don't worry about it, right? Don't anticipate the world ending when that happens, because it won't, right? It won't end. If you notice the the momentum line bounce, that doesn't really matter as long as it doesn't drop to an extreme lows. If it drops below the 5th percentile, that's when you start to worry about the momentum line. So not a concern right now. Let's take a look at the Dow. It's still a little bit away from its all-time high. That's why I don't think this bull market's really necessarily done yet. No green yearly high sticker that we have up here, but still a 19.5% one-year return for the last 52 weeks is not too shabby. You can see intermediate confirmation signal. So the near-term line has only been above 50 for not even 4 days. See, that day we were smidgen below 50. So the near-term line's only been above 50 for 3 days. So this intermediate confirmation signal, which is an oversold momentum line with the strong bullish posture, that could bounce us up for the next 3 to 4 days that we at least expect the near-term line to stay above 50. So bullish, short-term bullish bounce. Again, I wouldn't put a whole lot of stock into that considering how high up above we are, above that 8-day moving average. I'll show you here in a second. You know, the market's actually going higher at a faster clip than I expect this week. Which, you know, when the market goes up more than you expect, then at some point in time you can consider it fluff, and that fluff will be, we'll get that intermediate term pullback to get rid of that fluff. You can see the NASDAQ definitely got to a yearly high today. Nice big bounce. Those big tech names kind of resuming their leadership. It's kind of like, you know, the Yankees here. All those FANG stocks, you know, they traded for Stanton, and they got Aaron Judge, and they're back at it again. The big bombers are back. At least they're trying to show that they're back. We'll see if that ends up being the case or not. You'll also notice too that the Russell 2000 hit a new, it didn't quite get up above the intraday high, but a new all-time closing high. That's why you don't see the yearly high sticker here. But its near-term line has been above 50 for a little bit longer than the others. It's been now, let's see, not on this day, but 1, 2, 3, 4, 5, 6, 7, 8, 9 days. So we're getting towards the higher end of that 7 to 12 day window in terms of expectations of the blue line. The intermediate posture has been green. You know, light shaded pink does not change the trend, so it's dark shaded pink that changes the trend. So we've been bullish here for about a month, going on a month now, the month of August, continuing to push higher to near all-time high, new all-time highs. So, you know, the trends are bullish, the postures are bullish. We're in the kind of the middle stages of a near-term run, and you know, I don't expect necessarily that we'll continue at this pace, but you know, I expect us to continue towards the you know, and finish out and fulfill the back half of this near-term run, which means typically slowing, grinding moves higher, like I talked about on Monday, before we get at least a near-term pullback. If not by then, since we're 2 months in, a more intermediate term pullback to those Fibonacci support zones. Okay, before we look at some other charts here, as a reminder, you can watch our Market Outlook videos on our blog, marketscholars.com, and then go to blog at the top of the page. Do you want us to do this video again tomorrow? If the answer is yes, let us know. And the easy way to do that right now is by clicking here on that heart on tonight's Market Outlook tweet, and then click on like on that like button. You can also click on this this Facebook post, this image that will take you to your Facebook account, where you can like the post there as well, and then finally click on that heart. So 3 easy clicks tells us that you like the video today, you want us to do it again tomorrow. All right, now back to the charts, and again, the long-term charts, you really can't be more bullish than that. We are kind of starting to take off here to the upside pretty sharply. We've seen this before, and in the other areas, and usually when we get this far away, we start to slow down a little bit, but it doesn't mean we have to go down. And usually the market doesn't fall off a cliff and turn extremely bearish from these high levels when the MACD is that far up above zero. Usually it will grind for quite a period of time before it gets to zero. So the fact that we've been so high for most of this past year, really since peaking there in April, the positive momentum, the gap between the 50 and 200-day moving averages has been relatively strong. We don't really get significant sustained pullbacks to where, at least at this point, this chart turns pink until that gap shrinks over a period of time. We've seen that in the last couple of recessions. So again, another reason why I don't think a recession is around the corner, or a bear market even is around the corner, excuse me, anytime soon. I don't mean a bear market like, a sharp pullback like this, that was just so sharp because a rally was so strong. I mean a bear market where we are down below the 200-day moving average like that for an extended period of time. Whether that's a 20% return loss, usually is, but whether that's a 20% return loss or more, that doesn't matter. The fact that you get it below the 200-day and stay down there for a while, that's bearish, right? That tends to be more bearish, however you want to quantify or whatever you want to name it. So we're not in danger of anything like that anytime soon. When you look at the Hakinyashi candles, you'll see a strong bullish candle there. We continue to maintain a strong bullish candle, and again, we typically don't get a sharp reversal until we get smaller bodies and upper and lower shadows. So obviously we're not getting that this week. And you look at the 3 green arrow charts, maintaining strong, 3 green arrows, green shading here. You can see a lot more green shading than pink. So again, markets tend to be more bullish and bearish, especially when you're in bullish trends, of course. When you look at the 3 line versions of these indicators, you can see we're still way up above the 8-day moving average. So, we've seen before, again, at the beginning of these arrows marks a peak on the S&P above an 8-day moving average. So you can see how it can continue to grind upwards. This one actually went up quite a bit while we, after peaking above the 8-day moving average before falling back to the green line. So, again, I expect we got, the MACD is high above its moving average, so stochastics is high. The orange line's not extremely high, so, we're not in danger yet of being, of that intermediate pullback even. At least not in the next day or two. At some point we will, but strong bullish trends, strong bullish postures. At worst, we can expect it to grind back towards, that really fast 8-day moving average. All right, when you take a look, you can see the volume down here was a little bit above average at 61 million. Today's trading range, which, there was no gap, so today's trading range was just a little bit below the average. So, we're getting some pretty decent move today, especially considering it's a summer week, especially considering it's a Labor Day week, heading into Labor Day weekend. So, a bear, nice, good, solid, bullish move. You can see a new 4-week high point today. Higher high, higher low. Low of the day was early. The high of the day was late. Well up above last week's high. We're not in danger of touching that anytime soon. The purple line, you remember, is this week's open on the Hakinyashi candle. We're not in danger of forming a lower shadow anytime soon. We're not in danger of getting into the lower half of the chart here anytime soon, where obviously this would be below 286, which would be a significant support on an intraday basis at least. So pretty good all around, bullish pattern still. You take a look at this on an average basis. So our volume was just a little bit above average at 61 million. you see how, that might be like, oh, we had above average volume. Well, yeah, but very low relative to the 52-week range of that average. And then, of course, just under a point, just under 2 points, is below average on the ATR. The ATR actually has room to keep going down. So that shows how much more bullish potential we actually have before we get more of a significant pullback. And you can see the average, the ATR relative to the price is well below 1%. To get to 1%, the average ATR would have to get up, or the ATR, the average range would have to get up to almost 3 points, and it's at 2 points, so 2/3. We got a long ways to go before we get up above 1%. We'd have to consistently get 3-point moves on the S&P 500, bigger than 3-point moves. That's when you start to worry about being bearish. Until you get that, until you get the bigger moves, you don't have to worry about it, right? We'll just grind. It'll be slow, it will be steady, and it will be painful for those who think we should have this kind of a move. But that's the nature of these bullish grinding moves. Let's take a look at the volatility chart here. You can see volatility is not really dropping significantly. But again, there's not very much room for it to drop. I've mentioned this before. We entered a new stage of volatility at the beginning of the year, where last year the high point for volatility was 12.5. So now this year the low point is at 12.5 because we kind of we took a step up. We went a little bit below it there, but that was so extreme, and you saw what happened. That was such so extreme that we bounced up pretty sharply, especially on a relative basis here. We were so far below 80% that we jumped up pretty sharply in volatility up past 16. So the fact that we're not dropping, even though the market's continuing higher, that's actually okay, because this is the floor right now for volatility. I mean, theoretically, we can go lower, but if we do go lower, then the bullish trend is going to last even that much longer, because if we get lower than this, we'll enter another 2017, which I do not expect. That's why I'm not really banking on lower volatility as we continue to grind higher, because just like in 2017, we hit a floor too, and as the markets continue to move higher throughout the year, volatility stayed right around 10. Couldn't go very much lower, hit a floor, and that's where we went up a level, and now we're on the floor of that higher level. And I don't expect us to go back down a level to get back to that kind of volatility, because there's too much geopolitical and event risk to keep us from getting back down to that level. So to summarize, the markets continue to trend higher. We're on a bullish trend. At worst, things will slow down, is the expectation. Now, of course, anything can happen, right? But the worst case expectations right now, at least in the near term, is that we'll just slow down with maybe a bullish bias because of how bullish we've really been these last few days. But no expectations of an intermediate term pullback anytime soon. There will be one coming, but not necessarily anytime soon. And when it does come, considering the Fibonacci retracement zones up above the last intermediate high point, it will not be a problem. It might seem like it's a problem, and there might be a special, a special on TV about how the markets all of a sudden are bearish. But the reality is it will just be an intermediate term pullback into that zone that we wouldn't worry about until it breaks that. So that's my expectations going forward. What do you think? Do you agree with that? Do you disagree with that? Click on that poll that's popping out in the top right corner of your screen. And if you do click on the disagree up in that poll, let me know. Let me know what you're seeing that would suggest that we should be more bearish than what the chart is showing us right now with our positioning and with the trades that we're looking at. All right, now let's transition back into what's driving the price action today. You can see these alternative investments. Well, first let's talk about what was the best performers. Crude oil, commodities, your best performer. The dollar was down. That's been a key driver lately, is the U.S. dollar. The trend is changing on the U.S. dollar. It's got a strong bearish posture. It's below 50 on the intermediate line. Things are changing there, and these commodity prices, which have been so beaten up with these red moving averages and oversold clusters, are turning around, and still got strong bearish posture with the trade impacting these commodities, the ag commodities. But crude oil's showing a strong bullish posture, and gold is rising above 50 with a new bullish posture. We'll see if it ends up getting above like this mess here to new highs. So you can see MLBs, mortgage-backed securities down. So kind of like your alternative investments in those categories, the fixed income and the equity categories. Investment corporate bonds were down today, whereas treasuries were up. And from an equity standpoint, emerging markets outpaced U.S. stocks, and U.S. stocks just outpaced international stocks by a smidgen. Gold taking advantage of the drop in the dollar. There's your other equity asset classes, small caps and mid caps there, and growth outpacing value by 4 times, almost 4 times, and dividend stocks coming in with your lowest and preferred stocks and real estate lagging. So your alternative equities, preferred stocks, real estate, REITs, MLPs, all, and dividends, dividend-oriented stocks all lagging, growth-oriented stocks as well as international equities. I've mentioned before that the U.S. stock market had the potential for this bullish move into the end of the year. I think it's the international stocks that will provide the boost for U.S. stocks to make it there. If we take a look at how these foreign markets are looking here, we'll look at this one with the foreign market list over here, and you can see the emerging markets. They were your biggest winners today. Brazil coming off of its lows, Russia coming off its lows. Those are they both still have strong bearish postures, but their intermediate lines are rising from these low levels. So they're bouncing. India pulling back. It had the only loss on the day, but everything else. Look at France, got a green moving average now. Japan, green moving average. China, green moving average. It's been a long time since they've been green for at least a sustained period of time, at least in the past 3 months. You can see Germany will be green tomorrow now that its moving average is turning higher. South Korea, green moving average. Canada, green moving average. UK lagging behind. But green all across the board, except for India, green across the board with these really oversold emerging markets. And you can see China too, being your biggest winners. They've got the biggest losses in the 3-month period, 7%, 5.5%, 3%. South Korea down 7% too. They've got the biggest losses and they've had the biggest returns. Even Italy, on a European basis, Italy's been your biggest loser. And it's rallied. It had a big move up higher today too. So it was kind of like, let's move into these really beaten up areas and start looking for some value and lifting them higher. And that, the S&P 500 is coming along with it. So just because, at one point in time on August 15th, everything had a bearish posture except for the U.S. stock market. And just because now everything is turning higher and showing good, strong bullish postures, at least in France and in India, and close in Canada and South Korea over here, it doesn't mean necessarily that the U.S. stock market has to go down. All right, it can just continue to grind higher as a lot of these corrections, that double-digit corrective moves that have occurred in these areas, correct themselves back to the upside. If you take a look at the economic calendar, of course, the biggest news today was GDP. It was revised higher. There's this website I like to look at, consumerindexes.com, which breaks down the components. You can see 4.23%, strong move higher. Even when you take out the inventory, the declines, it was actually a stronger move, 5.2%. So, that's the strongest move you've had in the last last so many years. 3.6 was the highest back here, and next quarter is expected to be just as strong. Now this will be updated tomorrow, but next quarter is expected to be as strong. So you can see this is March now, so the odds of a rate hike in December are rising, up to 75% almost. So you're almost to the point where it's pretty much a guarantee we'll get a rate hike in December. It is a guarantee in September. But now you look at March and you can see the odds are still low. They're still only at 40%, and when you combine the 35 and the 4% over here, so we're about at 40%. It's still low probability, but it's higher than it was a week ago when it was only 29%. So the odds, and again, it's not a bad thing. In fact, if you take a look at the corporate profits, which also came out, they were up 6.7% year over year after a 2.7% the last quarter in Q2. That's a pretty good. Now, look at what happened in 2007 and 2008. You can see how the corporate profits were declining as we headed into the end of 2007. And remember, the Q4 2007 was when the stock market peaked. So we were already getting declining corporate profits. We had rising corporate profits all the way through 2006, which is when the Fed stopped raising interest rates, was in the middle of 2006. So all the time that they were raising interest rates in the middle of 2004 to the middle of 2006, you had rising corporate profits, which is what we have right now, in a rising interest rate hike environment, which again didn't prompt a recession until those corporate profits started to falter a little bit and started to come down. So again, we're not in danger of that, at least in the next day or two, week or two, or month or two, right? It looks like we still have nice continued sustained growth here, which will lead to bullish investor sentiment. All right, from a sector rotation standpoint, there's your two stalwarts, technology and discretionary, continuing to be higher. Now remember, the dollar was down a little bit, so that means material and energies are creeping their way up too. Healthcare continuing, new all-time highs, on technology, new all-time highs on discretionary, discretionary over here, technology over here. I mean, look at those runs in those three sectors. Those are your biggest movers. And of course, materials and energy, which have been the two laggards, they're going to start moving their way up this list. This is Brandon's sector selector list, sorted by his rankings, with utilities right now at the top. But I would expect, this to start to falter, and staples, as you see, they're pulling back. I would expect them to start to falter, and the technology and just make its way back up towards the top. And then eventually, with the weaker dollar, you'll see these two start to make their way up the top too, along with industrials, and you can see telecom. Now remember, there's big changes coming up in these sectors that will have an impact going forward on technology and discretionary as they create that new communication services sector. So that will have an impact on some of these sectors. And of course, as always here at Market Scholars, we'll adjust accordingly and talk about it as it happens here in September. All right, so one of the stocks that is in one of those beaten up sectors, Conoco Phillips, in that energy sector, getting a new all-time closing high today. Didn't quite break through its high point intraday high. That's why we don't get the yearly high sticker, but strong bullish posture now with the intermediate line rising. The near-term high, we had a near-term high here that we pulled back right there, and now are bouncing back up off of that low point. Bullish posture, bullish moving average. You can see from a 3 green arrow standpoint on Conoco Phillips, about average volume with a continued set of 3 green arrows here, coming up off that big 3 red arrow bounce that we had. From a long-term viewpoint, you can see that it's been rising above this 50-day moving average. It's been coming up off of some lows. That strong bullish posture, the strong dollar really pushed it down, and the strong dollar this year hasn't really impacted it. Now that the dollar is starting to weaken, it will give it. This is the kind of sideways action it had during this dollar strength. So now that the dollar is pulling back a little bit, it allows it to have a little bit of a lift off, and of course it's in a weaker, and it's got strong long-term momentum with this MACD as high as it is. Of course, when you look at like the Bollinger Bands here, you can see this break. Of course, 52-week high breakouts mean there's no volume to the upside. Lots of volume here below where we're at. So strong support where we're just right below where we're at here because of how long we've traded in this area. So a positive sign from that perspective. And then, of course, when you look at the DMI its DMI positive lines up above 25, which is what you want when you're bullish, right? Because it can stay bullish when it's above 25. So positive sign from that perspective. So an opportunity to sell a put, with 23 days out. We can go out further, but we're over 20 days. We're still getting a 30% return on risk at the 72.5 put. When you analyze that, you still get decent odds, and you also put this break-even line right below that near-term low point. Remember, that's the near-term low point here. So get the market forecast again for COP. There's the the previous near-term low. So as long as we don't form a lower near-term low, then you stay above break-even. Of course, we can go a little bit below break-even before we get to that $50 loss or $60 loss, which is what we're willing to take on this. And of course, you can see how you can get to that first 50% of its gains really quickly. It's the other 50% that takes a lot longer. So if we can get there quickly, we'll take it. Otherwise, if we kind of languish in this area, then we'll just let that time decay push this line up higher and get us towards our maximum gain levels. All right, so that wraps us up for tonight. Now, I want to hear from you. What do you think about this market posture? What do you think about our trade idea tonight? And what's driving this price action? I want to hear your thoughts. Do you have any questions about anything we talked about? Do you have any comments? Do you have any questions about anything I didn't talk about that you wanted my take on? Remember to respond in our forums with that link that popped out earlier. You can get back to it by clicking that I in the top right corner of your video. But there's also the link right above the video on our blog that will take you directly to tonight's thread in the Market Scholars Forum. So want to hear from you. As always, thank you very much for watching tonight. Have a great rest of your evening. Stay tuned as we dissect the markets day in and day out here. Follow us on Twitter. Join our Market Outlook community on marketscholars.com as well as on Facebook. Subscribe to our YouTube channel. Like the video tonight. And comment as always. So thanks again. Have a great one, everybody. We'll see you all next time.